Okay, so I'll get whoever comes in from now on, I'll get you for the attendance later on, more toward the end of class as we're finishing up. Okie doke. So let's talk about what we're going to be doing in class today. We're going to start with a brief review of what we did on chapter 2 on Friday, and then that was learning outcome or objective 2-1. So today we're going to go over learning outcomes or objectives 2-2 and 2-3. And to do that, we're going to be using the Accounting Essentials document that we used last time, but we're also going to be using a worksheet because we're going to go right into problems. I want to be able to demonstrate the concepts that we're learning right away. So for homework, remember your test is due tonight. You had since Friday at 2, and you're allowed to go in and out of the test using the save and exit the same way you did with your homework. But once you submit, that's it. There's only one submission. Remember, you're allowed one check my work per question. The late deduction is 20% for each day late. That means if you don't get it in by 11:30 tonight, then the highest grade you could achieve would be an 80% up until Tuesday night. And then it goes down to 60% and 40%, in other words, with each day late. So please make sure you get it done. It's not a long test, 10 multiple choice, 2 questions, so 2 problems, so not a long one. You can also begin the chapter 2 concept overview video, so you get that done. We're going to be actually covering 75% of the chapter today, and then practice, and we'll cover the other 25% on Wednesday, and Friday we're going to be doing a big problem. So if you could watch the mini lecture for learning outcome or learning objective 2-4 and 2-5, that's in Blackboard. That would be great. And I'll be posting the recording of this class in the Zoom sessions folder, which is the last folder in the chapter 2 folder in Blackboard. Okay, so what we did on Friday. Let me just maximize my screen here. And this was the document we used in Friday's class, Chapter 2 Essentials. What we talked about on Friday was just maybe the first 2/3 of the page there. Let me zoom out just a little bit. We're going to be looking in this chapter at transactions that affect the balance sheet. We learned how to do the balance sheet and income statement and statement of retained earnings. Now we're going to learn how to get the information into those statements. First of all, we talked about what a transaction is. A transaction is a business activity that has a financial effect on the assets, liabilities, or stockholders' equity of a business. Not all business activities are transactions. And you're going to see in a few homework problems that they throw in some business activities that are not transactions just to see if they can catch you in recording them. For example, there may be a transaction that's a personal transaction of a stockholder. But we know because of the separate entity concept or principle that personal transactions of owners are not supposed to be recorded in the business records, just the business's activities. Each business stands as a separate entity. There may also be some transactions or some activities that don't qualify as transactions because they don't have a financial effect. They don't involve money. So what types of transactions will we be recording? First of all, financing activities. Financing is a way for how we get money other than through day-to-day operations. And we can get money through equity financing, which means through owners' contributions. In corporations, that would be by selling stock. Or we can get money by borrowing it. That's called debt financing. And then with that money that we get, we can then invest in purchasing assets. We said common features to all transactions are that, first of all, there has to be some proof that it occurred, some type of document to back that transaction up. That every transaction involves a giving and a receiving. There are at least 2 effects on the accounting equation. That's called the duality of effects. We'll be seeing that today. After every transaction is recorded, the accounting equation stays in balance. And then finally, we learned about the cost principle, which states that when you buy assets, they should be recorded at their cash equivalent price. And then we leave them on our records at that amount. Then we talked briefly about these 3 steps, which we will actually accomplish today. We're going to learn how to analyze the transaction. when we picture that transaction, what accounts are affected and are they increasing or decreasing? And by accounts, we mean specific assets, liabilities, and stockholders' equity items. These are, this document can be found in the Please Print folder. It's a listing of asset accounts, liability accounts, and stockholders' equity accounts that we'll be using, in recent chapters, either this chapter or future chapters. Accounts are simply places to record activity in specific assets, liabilities, and stockholders' equity items. So in the cash account, we record increases and decreases to cash. In the accounts receivable account, we record when people buy from us on credit and then when they pay us off. In accounts payable, we record when we buy things on credit and then when we pay them off, and so on. So these are specific accounts. Assets is an account category or an account type. So we'll be asking ourselves, what accounts are affected? Are they increasing or decreasing? And then what type? Are they an asset, liability, or equity account? Because that will help us do the next step, record the transaction or journalize the transaction, recording it in the daily record of all the business activities that affect the accounting equation. And finally, we'll be copying from the journal into the individual ledger accounts. Now, how do we record the accounts? We record them using the rules of debit and credit, which is based on the accounting equation. We're going to see that on page 3 in just a moment. And then at month end, before we prepare the financial statements, we're going to learn on Wednesday how to prepare a trial balance, which is kind of like a sloppy copy of your term paper, your rough draft. You didn't want to hand the instructor your first trial draft because you want to make sure it's perfect. We're going to check and see if our recording process is accurate in terms of debit, credit, and quality, which I'll explain in a few moments. And that will tell us if our balance sheet will balance. If the trial balance does not work out, then your balance sheet won't either. And then we'll come back to this in a moment when we talk about the third step of copying. Okay, so I'm going to go to page 3 here, how to record transactions using debits and credits. Zoom out just a little bit here. Okay. So we said all of these are accounts, places to record increases and decreases in these individual asset, liability, and equity items. Well, each account in its most simple form can be expressed using a T. So we call them T accounts. Now, in the real world, we wouldn't use this account structure. I'll show you the paper we would use in a moment. But even the fancy paper has the T in it. The account name goes at the top. And the left side of every account is called the debit side. The right side of every account is called the credit side. So essentially, try to remember that debit means left, credit means right. That will always be the case. And it's going to be a little bit of a challenge because you'll be thinking in your mind about debit cards and credit cards. Kind of forget about that for now. And I'll explain in chapter 5 when we talk about banking, why they're called debit or credit cards. So debit for us just means the left side of a T and credit means the right side of a T. We abbreviate debit with DR and credit with CR. Now you might think, okay, CR makes sense because there's a CR in credit, but there's no letter R in the word debit. So why would we abbreviate it that way? Well, the words debit and credit come from the Latin words debere and credere, because this system of recording transactions was written down in the 14th century by an Italian monk by the name of Luca Pacioli. And this system that you're learning and that everyone uses till this day had been in use for even hundreds of years before Luca wrote it down, and primarily in the Mediterranean region. So Greece, North Africa, Spain, Italy, they had been using this system, but no one wrote it down. So since he was the first one to write it down, Luca Pacioli got credit for it. So the R comes from the Latin word debere and CR for credere. So remember, an account, whether it's cash or accounts payable, is simply a place to record increases and decreases in individual asset, liabilities, and stockholder equity items. Every account has a left side, that's called the debit side, and a right side, that's called the credit side. Now we said the first step in analyzing every transaction is to analyze every transaction. And to do this, the easiest way is to picture what's happening, then to name what is being exchanged. Remember we said there was a giving and a receiving? So what two or more accounts are being affected? And then we analyze, how does that affect the accounting equation? What type of an account is it? Is it increasing or decreasing? So what I'd like to do is I'd like to go right to problem M2-9 on our worksheet and work that out together to show you what I mean by analysis. So we're going to go to this right here. Now, in the real world, this part that we're learning right now actually occurs in the accountant's mind. And you know what? You're going to be able to do this in your head in a few chapters as well. But to learn how to apply the debit credit rules, it's better to start learning it this way on paper, and then we'll move over. Oh, you know what? Now we'll talk about chart of accounts later when we're posting. Okay. So it says for each of the following transactions of Spotlighter Inc. for the month of January, indicate the accounts, the amounts, and the direction of the effects on the accounting equation. And they gave us an example here. A. Spotlighter borrowed $3,940 from a local bank using a note. That means a promissory note. Spotlighter promised to pay the $3,940 in 6 months. Now, by the way, if a note is due in 1 year or less, it's called a short-term note. Short-term note equals 1 year or less. It's due in 1 year or less. So they promised to pay in 6 months, so it's a short-term note. Okay, so we ask ourselves, you close your eyes and picture it. What's being given and what's being received? Well, since they're borrowing the money, they're receiving cash. And what they're giving is the promissory note to pay later. Cash is an asset, so we wrote it down under assets with the amount. Promising to pay, that's a debt, right? So that's a note payable. That goes under liabilities, which are our debts. And after we write this down, the left side must equal the right side. Every transaction has at least 2 effects on the accounting equation, and then after we report it, the accounting equation stays in balance. Assets, $3,940 equal liabilities of $3,940 and 0 effects on stockholders' equity. So let's try another one. Spotlighter Incorporated received $4,630 in cash from investors and issued common stock. So what's being received? Cash. What's being given? Common stock as evidence of their ownership. So and cash is an asset, so we'll write cash down here, and then $4,630. Now on Connect, you won't have to put a plus to show that it's increasing. You would only have to show a minus. It's assumed that if the figure has nothing in front of it, that it's a plus. So cash, $4,630, and then we want to record an increase in common stock. That's a stockholders' equity account. So we'll put that, I'll abbreviate that to be able to fit it. Now notice I didn't use the top line because we want to keep the transaction all on the same line. And then we prove to ourselves assets increased $4,630. That equals an increase in stockholders' equity $4,630. There was no effect on liabilities. By the way, in the real world, we use dates, we don't use letters. I don't know why in textbooks they love using letters, but in the real world, we use dates for transactions. Let's look at our third one. Purchased $1,000 in equipment, paid cash, promised to pay the rest, which is $800, right? On a note due in 1 year, still considered short-term note. So what was being received? equipment. What was being given? The cash and the note. Okay, equipment is an asset, so we'll write that under the assets category here. And equipment is going up by 1,000. If we leave it as a clear figure, that will show an increase. What was being given? Cash. Cash is also an asset. But if you give cash, it's being reduced, so we'll show a minus 200. And the other thing we gave was a promissory note. So that's a liability. You can either put it on the line where equipment is or cash, either one. And that's for the other $800. And now we have to make sure our left side of the accounting equation equals the right side. The assets went up by 1,000 and down 200. So it's a net increase of 800, and that equals the net increase in liabilities of 800. Stockholders' equity was not affected. Any questions at all? Okay, now let's talk about the next one in D. Paid 300 cash for supplies. So if we picture it, what's being received is supplies. What's being given is cash. Both are assets. So it doesn't matter which one you put first. I'll put supplies first. Supplies is going up by 300. The asset cash is going down by 300. There's a zero effect on assets. Oh, that's equal to the zero effect on liabilities and stockholders' equity. You're exchanging one asset for another. So the accounting equation stays in balance. And finally, in transaction E, bought and received $700 of supplies on account. On account means on credit, right? They're not paying for it right now. So what was received was supplies. What was given was the promise to pay later. We call that accounts payable. It's different than a notes payable because a notes payable uses a formal agreement, a promissory note. Plus, notes usually get interest right from the day they're made, where you won't have to pay any financing charges on your accounts payable unless you don't pay your debt on time. So we use accounts payable for when we buy things on credit. Okay, so what we received was supplies. Supplies is an asset. That will increase 700. And what we're giving is a promise to pay later. We call that a liability, accounts payable. I'll abbreviate that here. And our left side, 700, equals the right side, 700 increase. No effect on stockholders' equity. Okay. Does anyone have any questions?
If it doesn't say, if it says bought and received $700 of supplies, if it does, will it always say on account?
It should say, they should be telling you, yep, whether it's on credit or not. Sometimes they use the word paid when they mean paid in cash. Sometimes they don't say cash, they just say paid 300 for supplies, and you have to assume it's paid in cash. For things that are bought on credit, they'll say either on credit or on account, but most often they say on account. If it's a note payable, they will tell you it's a note. Good question. Okay, so we did step one, the analysis. As I mentioned, later on you'll be doing this in your head quite easily. Right now, it's going to help us when we do our next step, the journal entries, because we're going to be learning those rules of debit and credit. Okay, so I'm going to go back to our Accounting Essentials document, and we did step one. Okay, so far, all we did was use the transaction analysis form. We haven't used any accounts yet. We said in the real world, our accounts don't look like this. Let me show you what they look like. They would look more like this. Each account would have its own page. Up here would be the account name, maybe cash. And then we would assign our accounts a number. We'll show you the definition of chart accounts in a moment, but basically we use account numbering, the account number system, where all assets are assigned an account number starting with a 1. All liabilities starting with a 2. Equity accounts, their account numbers begin with a 3. Revenues begin with a 4. Expenses begin with a 5. So for this account, perhaps I'd give it 101. And instead of just a simple T like this, which we're going to use because we don't want to kill a lot of trees using up a lot of paper, we're going to use these. But in the real world, each account would have a full page that looks like this. And there's the T. We would put the date of the transaction. We would put whether there's a debit or a credit, and then we calculate the account balance. You're going to learn next time how to calculate account balance. So every account would have a page like this, and they would be in a book, kept in a book all together, called the ledger. Now, I mentioned, and even, by the way, even if it's electronic, there's still a ledger. If you're keeping computerized records, they'd be in a ledger, but it's just on the computer. So every single account that you have, you keep in a book called the ledger. And in the front of the ledger, you're going to have a listing of the account names and their corresponding numbers that you've given them. Now, I just used a 3-digit numbering system, 101, but you can use as many numbers in your account numbering system as you want. If you're a very large company, maybe like Target, you might use 101 for cash, but then you might have a country code that goes next, and a region code, or a city code, a particular store location number, so that you can know how much cash you have at a particular store. The system can be very sophisticated. We're gonna keep it simple. And we said that no matter what company you go to in the United States, you're gonna have a chart of accounts, and all the asset accounts will begin with a 1, all liabilities with a 2, equity with a 3, revenue with a 4, and expenses with a 5. And we use numbers for a lot of things, like our social security number or our student ID, right? It gives us a digital way, an easier way, I should say digitally, to represent different types of information. So the chart of accounts is going to function for us like a table of contents that will help us find the account in the book of accounts called the ledger. Because if every account has their own page, we might need to find a particular account quickly. And if we look at the chart of accounts, it'll give us the account number and we can find it more easily. Okay, so back to our page 3 again. The next step is to journalize or record the transaction. And the word journalize has the word journal in it. A journal is a daily record, right? Like a diary. And basically, this is a diary or a daily record of all the business's transactions. So it gives you the whole transaction. What 2 accounts are affected? Are they increasing or decreasing? And then we give a little explanation as to what happened. So what we're going to do is we're going to switch out our pluses and minuses for the words debit and credit. And instead of using pluses and minuses, we'll use the words debit and credit. So the rule is accounts increase on the same side as they appear in the accounting equation. So here's the accounting equation. I put a little T account under each. Remember, the debit side is always the left side. The credit side is always the right side. So we just said accounts increase on the same side as they appear in the accounting equation. So if assets is on the left side of the equation, we increase on the left side. Liabilities and stockholders' equity are on the right side of that equal sign, so they increase on the right side. And to decrease, just do the opposite. We credit to decrease the assets, we debit to decrease stockholders' equity. But if you learn the rule how to increase, just remember to decrease, do the opposite. So let's use an example. So you're going to come back to this a lot probably. And the good thing is, as long as you know the accounting equation, you know the rules of debit and credit. Okay, so here's an example of a transaction. On August 1st, Sonic Gateway issues common stock to Scott and Angus as evidence of their investment of $10,000 in cash. So if we analyze that, if we close our eyes and think about what's happening, Sonic Gateway is receiving $10,000 in cash, and they're giving common stock. Okay, if they're receiving cash, cash is an asset. So to increase cash, I'm going to have to debit it, because that's how I increase cash. Common stock is a stockholder's equity account. To increase common stock, I credit. So my entry will be, and we always put the account to be debited on the first line. So put the date, we put cash on the first line, since that's going to be debited, with the amount in the debit column. And then we put common stock after that, indented a little bit with the amount in the credit column. So we increased the cash account, we increased common stock. We're going to explain posting references in a moment when we do step 3, because that's when we. Okay, so now let's go back to our problem that we were working on, and let's do the same transactions as here, but now we're going to actually journalize them. And again, in the real world, we'd use dates, we would be using letters. Okay, so let's do A first. In A, Spotlighter borrowed $3,940 from a local bank using a note. And what we said was, Spotlighter received cash and they gave a note. So the way we recorded it was we increased the asset cash and we increased the liability note payable. If we go to our rules, to increase the asset cash, we would have to debit it. Well, whatever we debit goes on line 1, so let's put that here. And let's put the amount, $3,940, in the debit column. And do you notice the debit column is on the left side and the credit is on the right side? And that helps us remember when we go to post later on. I'm just going to put this plus A to help us remember we're increasing the assets. That might help you remember the rules. Then we're going to go to notes payable and increase that. Notes payable is a liability. To increase liabilities, we credit. So that will go on the second one. With the amount in the credit column. Every journal entry has to have at least one debit and at least one credit. There's no such thing as a one-line journal entry. You have to have at least one debit and at least one credit. If you have one of each, then the numbers have to match. If you have more than one of each, you would first list all the debits, then you list all the credits, and then you have to add up all the debits, add up all the credits to make sure that they total the same amount. Let's look at the next one, and unmute yourself and ask a question if you have any questions. In B, received cash and gave stock. Oh, this is like the one we just looked at in our example from over here, right? And so we received cash. We put cash under the assets here, and we gave stock. We put stock under stockholders' equity. If we want to increase cash by $4,630, increase assets like cash, we debit. Let's put cash on the first line. Because the account to be debited goes on the first line. Common stock is a stockholder's equity account. We want to increase that. So we go to stockholders' equity, increase, we credit. So we put common stock on line 2. That's an increase in stockholders' equity, and we credit. Now, you won't be able to put pluses and minuses like this in Connect. I'm just doing this to help you remember that by crediting, you increase stockholders' equity. Any questions? Okay, let's go to C. In C, purchased equipment, $1,000 worth. That's what we received. And what we gave were 2 things. cash, and a notes payable. Okay, equipment we said was an asset, right? We want to increase assets. To increase assets, we debit. Let's put the debit on line 1. And what we gave was cash and notes payable. Cash is also an asset, but if we're paying it out, we need to decrease it. Well, to decrease assets, we credit them. We put them on the right side. So we'll put a minus A there, and I'm going to put a credit to cash there. And the other thing we gave was a note payable. A note payable is a liability. We want to increase that debt. So to increase debt, we credit. Payable, that will be an increase to the liabilities or the difference, 800. Now this is an example of a compound journal entry. There's more than one debit or credit. The total debits are 1,000. The total credits must also be 1,000. When you have a compound entry, the total debits must equal the total credits. All the debits would go where you get listed first, then all the credits. Any question about that one? That was a little trickier. Okay, next one in D, paid cash for supplies. So what we received was supplies. What we gave was cash. We recorded it this way: an increase to the asset supplies and a decrease to the asset cash. Okay, so they're both assets. We want to increase supplies, so we'll debit that. And we want to decrease cash, so we'll credit that. The account to be debited goes on the first line. That will increase the asset supplies for $300. And now we'll decrease the asset cash for the same amount. Increase to supplies, decrease to cash. We're doing the same thing as we did in the transaction analysis. Now we're using the rules of debit and credit and journal entries the way accountants do. The last one, bought and received $700 of supplies on account. This time we didn't pay for it. So we're receiving supplies, we're giving a promise to pay later. We said supplies were an asset and we want to increase that asset by 700. Well, to increase assets, we debit, we put them on the left side of a T account. So debits go on the first line here. That's 700. And since we're not paying for this right now, we're going to pay later. We're going to increase the liability accounts payable. To increase liabilities, we credit. Okay, so we just journalized 5 transactions. Okay, so let's just run through a few things. We're using the rules of debit and credit, which are based on the accounting equation. If you know the accounting equation, you know the rules of debit and credit. Assets are on the left side of the equal sign, so we increase on the left side, which is the debit side. Liabilities are on the right side of the equal sign, so we increase on the right side, which is the credit side. If you don't mind getting an earworm, one of those songs that you can't get out of your head, there's a video in the Chapter 2 folder called Colin Dodd's Debit Credit Song. The good side is you'll never forget that debits are on the left and credits are on the right. The bad thing is that you might have an earworm and not be able to forget the song. I heard it once and I've remembered it the rest of my life. Okay, So the other thing we need to remember is that there's no such thing as a one-line journal entry. You have to have a debit and a credit for each journal entry. If you have one of each, they must equal. If you have more than one of each, total debits must equal the total credits. And the debit always goes on the first line, or the list of all the debits go first, then all the credits. Any questions on any of those? Okay, the last step is the posting process. If you wanted to know the balance in your cash account, you'd have to, if you were using just the journal, you would have to say, oh, increase to cash, add that increase to cash, decrease to cash. It would drive you nuts, right? It's better to have a cash account like we talked about here, where you can always know the balance of what you have in cash. So in this last step, we're going to take the information in the journal and we're going to copy it to our ledger T accounts. There. We're going to pretend that each one of these is like one of the fancy pages that I just showed you, because we don't want to use up that much paper. So each one of these is an account, and this whole group of accounts together is called the ledger, the book of accounts. And I kind of organize them according to the accounting equation. Now, in our handout, it says here to copy the third step, the copying or posting. All we do is follow the directions from the journal. So the journal says, go to the cash T account and put 10,000 on the debit, which means the left side. There we go. And then we go to common stock T account and put 10,000 on the right side, the credit side. And we're done. Now, where do these numbers come in? Well, remember we said that every account number, or every account has a number, we assign it a number. What we would do in the posting part of this is we would take the account number for cash and put it in a posting reference column. And then we would take common stock's number and put it there once we've posted. And that does two things. First of all, if you get interrupted by a phone call or lunch hour, you know where you left off because you put the number in the posting reference column of where you left off. But secondly, it allows you to trace back so that if you, for example, posted to the wrong account, you would realize it by looking at the posting reference column. You'd have the wrong account number in there. Or if you're in the cash T account and you think to yourself, why did cash increase 10,000? I could look at the date and look at my journal and find out why there was an increase to cash. So the date functions as a posting reference in the T accounts, and this column focuses to cross-reference in the journal. Now, Connect's not going to ask you to do that, but I thought I'd point this out just so that you know. If you're seeing a set of books, you'll be familiar with it. Okay, so now let's do our posting. Let's see, we've got, well, I think we'll finish it in 5 minutes, 7 minutes. Okay, so we're going to go to our first journal entry, and this is actually the easiest thing you'll probably learn this semester. We're going to follow the directions of the journal. The journal says, go to the cash T account and put $3,940 on the left side. Go to cash and put $3,940 on the left side. I'm also going to use the letter A. In the real world, we'd use the date. Here, I have to use the letter A. I'm going to zoom out so I can get a little bit more of the paper on. I'm just going to put a check mark here so I know where I left off. In Connect, you will not be able to do anything here, but they will ask you to put the letter. Now let's go to the notes payable T account in our general ledger, which is there. And it says put $3,940 on the credit or the right side. And there we go. We've posted our first transaction. It's just copying. Now let's go to transaction B. It says go to the cash T account in the general ledger. Here we are. Put $4,630 on the debit or left side. Then go to the common stock account in the general ledger and put $4,630 on the credit or the right side. Now, when you do this in Connect, what you do is you keep your numbers close to the inside of the T-bar here, and put your letters on the far outside. They'll give you, well, you'll know because you won't be able to put numbers in the letter portion or letters in the number portion. Okay, now we've got this compound entry. We go to equipment, which is an asset, and we put 1,000 on the debit or the left side. I'm going to have to scroll up a little bit here. Put 1,000 on the debit or left side. Check mark there. Now it says go to cash and put 200 on the credit or the right side. So here's cash. We're going to put 200 on the credit or the right side. And then go to notes payable and put 800 on the credit or the right side. Any questions? Okay, let's go to supplies. It says go to supplies, which is an asset, and put 300 on the debit or the left side. I'm going to move this up a little bit. There's the debit or left side of the general ledger T account called supplies. And then it says go to the cash account and put 300 on the credit or the right side. And finally, it says go to supplies again, put 700 on the debit or the left side. And then go to accounts payable and put 700 on the credit or the right side. And there you go. You've done about 75% of the chapter today. What's left is calculating account balances, in other words, to calculate how much we have in cash, supplies, equipment, and so on. And then preparing the trial balance, which is pretty easy, and the classified balance sheet. It's just a few new things to learn about the balance sheet. At this point, do you have any questions for me? Okay, so the next time we come together, we'll learn how to calculate account balances. We're going to learn how to do an unadjusted trial balance, and we'll learn about the classified balance sheet. That's Wednesday, and we'll probably start the big problem, the comprehensive problem that goes through this whole process with lots of journal entries. You know, the only way you get good at this is by doing a lot of them, and then it'll come so naturally to you, you won't have to use the accounting equation. At first, it's a little sluggish. It takes a little bit of time. You know, you're thinking through the process. I always used to keep handy my accounting equation so I'd remember whether I need to debit or credit to increase or decrease accounts. But pretty soon, this process will become very easy for you. Okay, so the next time this is what we did today. We covered learning objectives 2 and 3. We used the Accounting Essentials document in the worksheet to do three parts of the problem. Test 1 is due tonight at 11:30. You're allowed 1 check my work per question, and you are allowed 1 submission. Please do actually click on submit, because otherwise it won't be submitted for grading. So you need to make sure you click on. There's a late deduction of 20% for each day late. You can hand it in late, but it'd be nice to avoid it. You can begin watching the concept overview video. I mean, you're welcome to start the homework too if you'd like. That's fine, but I know you're gonna have a lot to do. There's a short mini lecture for Learning Outcome 2-4 and 5 in Blackboard. If you could watch that for Wednesday's class, we could go right into the trial balance and calculating account balances, and then we can start that big problem, because I think that's going to take us about a day and a half to do. At this point, do you have any questions for me at all? Okay, let me just check to make sure I have everybody in here. So I see a few people came in that I didn't know about. Let's see, we've got Alyssa, we've got Josiah. Let me just see if I'm missing anyone here. Oh, Donnie. So let me just do a quick look through. Unfortunately, they don't give them to us in alphabetical order, so I have to go through each name again. We've got Julius, we've got Allie, we've got Justin, okay, and Brooke and Zach, and Caitlin, Tyler, Jackie, Chris. You know what? There's someone here who does not have a name. It's just like a blank screen. So I'm not. Oh wait! I see it. I see it now. It was below. Got it. Okay. Almost done here. Ah, Nate Cohen. There we go. There you are. Emmanuel. Okay. I don't see Taylor Sanders as I'm looking through the list, or Lori Thomas. Are you here, Taylor or Lori? Well, you know, I can just check the number. 24. 1, 2, 3. Yep, okay, we're all set. So we're all set for the day. You have a good rest of the day, and we will see you on Wednesday at 11. I'm going to be posting the class later on after I have to upload it. I have to convert it and upload it to YouTube, then download it to Blackboard. So that takes a little bit of time. I won't have a break until 3 o'clock today, so I'll probably do that a little bit after 3 in case you had wanted to watch it again. But have a great rest of the day, and feel free to join in my office hour at 1 o'clock. I'm happy to chat with you then. Take care.
Thank you.
You too. Bye-bye.
Thank you.